Welcome everyone. Today I am going to be going over Chapter 13 of the Canadian Securities course. It is also Volume 2, so it is the first chapter for the second exam, and I will be discussing fundamental and technical analysis. So first off, fundamental analysis versus technical analysis. So it is really important to know the difference between the two. Fundamental analysis, it is a method of assessing short, medium, and long-range prospects of different industries and companies to shed light on the security price. Often you might use things like profitability measures or ratios to determine the value of a stock or a security. And I have an example here. So evaluating the company based on the industry, the life cycle, or the economy to protect whether the security price is overvalued or undervalued is a type of fundamental analysis. Now, moving on to technical analysis, it is a bit different. Basically, it is just the study of historical stock prices and stock market behavior to predict future prices and behavior. So an example is just annualizing price patterns to predict future stock prices. And of course, this isn't always true. It's often not. And we will get into that when we look at market theories, which is next. So there are three different main market theories. The first one is the efficient market hypothesis. This is sort of the main one, and it does have an assumption to it. So the assumption is when new information about a stock appears, investors reassess the intrinsic value of the stock and adjust their estimate of its price accordingly. And basically, this means that the stock's price fully reflects all available information and represents the best estimate of the stock's true value at any given time. Now, there are actually three different variations to the efficient market hypothesis. You have weak form, semi-strong form, and strong form. Now, weak form, it assumes that all past market information is fully reflected in the current price. Semi-strong form goes a bit further. It assumes that all publicly available information is fully reflected in the current price. And then strong form assumes that all information is fully reflected in the current prices. So this includes both public and insider information. So obviously, if the efficient market hypothesis is right, whenever some information becomes revealed, basically, it will instantly go to that stock price. So if it's positive news, the stock price will increase. If it's negative, it will decrease. And that will happen basically instantaneous. Now, on to the random walk theory. This is another market theory. So this is when new information concerning a stock is disseminated randomly over time. So price changes are therefore random, and they actually bear no reflection on previous prices. So obviously, when we looked at technical analysis in the previous slide, if random walk theory is true, then technical analysis basically has no actual worth. It obviously wouldn't work if random walk theory was correct. Now, the conclusion with random walk theory, it is basically that past price changes contain no useful information because any developments affecting the company have already been reflected in the current price of the stock. We also have a third market theory, which is rational expectations hypothesis. This is sort of a mix of both. It adds a little bit of human psychology in it as well. So the rational expectations hypothesis has an assumption where people are rational and they have access to all necessary information. People use information intelligently in their own self-interest and make intelligent decisions after weighing all available information. Now, the conclusion with this theory is that past mistakes can be avoided by using available information to anticipate change. So basically, this theory is saying that you can weigh the different information and you can avoid some past mistakes and sort of anticipate the change in the market using this information. So this is actually one that sort of has that little bit of human psychology into it. So it might be one that you guys might believe in. But yeah, those are the three market theories. So now that we know the market theories, basically the chapter goes into the sector and industry groups. It is really important to understand each of these, especially later on when we go into the different types of industries and different types of stocks. So first off, of course, we have the communication services. This is a basically telecommunication company, media and entertainment companies. One that you can obviously think of in Canada is Bell Canada or even Rogers. And now moving on to consumer discretionary. This one is actually quite broad. It basically involves just items that consumers or people just buy for no reason with their extra money. So consumer discretionaries, they consist of automobiles, consumer apparel, so clothes, consumer services, and retailing. When people have more money to spend, consumer discretionaries tend to do quite well. Consumer staples is another sector or industry. This consists of food, beverage, tobacco, household, and personal products. So it is sort of a staple. It's needed. That's why it is called consumer staples. And this doesn't usually tend to go down since they are something people always need. It could sort of be considered a defensive stock, if you will, and we will go into that later in this chapter. Next, we have energy. Energy is quite straightforward. It is just energy stocks. It can be oil, gas, natural gas, just anything that creates power, electricity, things like that. And next, we have financials. So financials, it is banks, just diversified financials, insurance companies. It can be sort of financial service companies like Manulife Securities or Sun Life. Just any of those sort of finance type companies. Some other sector and industry groups include healthcare. So this would just be healthcare equipment, some services, pharmaceuticals, biotech, and life sciences. We also have industrials. This is capital goods, commercial, and professional services. Informational technology consists of software and services, technology, hardware, and equipment. So obviously you can think of some big tech companies like Apple, like IBM, companies like that. We also have materials. So this is lumber and minerals, copper, things like that. There's also the real estate sector, which is just real estate, and then there's utilities. So utilities consists of sort of electricity companies. So next we are going to be classifying the industries by life cycle. So this is basically another way to classify stocks. You can put them in these different industries based on their life cycle. So life cycle starts off by emerging growth industries. So these are companies that tend to be unprofitable at first, but their future prospects may be promising. These stocks usually go quite cheap. They don't have a dividend or anything like that. You're basically buying in to the potential of the stock. Growth industries are a bit further in that life cycle, but they still are consistently expanding at a faster rate than most. They're not mature yet, but they do tend to have above average rate of earnings on invested capital. So they are just consistently expanding, consistently making more money. So you can buy into that potential that they will become a top company at some point. Mature companies, they have slower, more stable growth in sales. They have a positive earnings and cash flow. Often they would have a dividend. You can think of mature companies like Microsoft, Apple could be considered mature. Could also be considered growth since it is still expanding at a significantly fast rate as well. So that is the thing with these. You can sort of put stocks in more than one category, or they could be in between. It isn't just a defined set thing. We also have declining industries. So this is right at the end of the life cycle. You sort of hit an apex at that mature industry spot, and then you start to become declining industries. So this is companies that tend to stop growing and they do begin to decline. So they produce products for which demand has declined and they are unable to compete on price or changes in consumer tastes. One famous declining industry was the railroad industry, of course. It was overtaken by transport trucks, by cargo on ships and planes, so things like that. So that industry definitely had that decline. One that might be declining at some point, I think, could be the oil industry. Of course, the demand for that still is increasing in the next 5 to 10 years, but we will have that shift to renewable energy, electric cars. So you can see that at some point the demand will stop growing and it will begin to decline, and they will be unable to compete on that consumer taste. So I do think that will be a declining industry in the future. And so next we have Porter's 5 forces. This is basically 5 forces for companies that they really go off of. It shows you how strong the company is, or how difficult it might be for competitors in that industry. So first off, you have the threat of new entry. This is quite straightforward. Just ask the question, is it easy for new competitors to enter the market? If it is, then that's sort of a negative. It makes it so you could have more competitors come in. It causes a risk to the company. If it is hard and there's a lot of barriers to entry, then obviously your company is a bit safer, since you probably won't be seeing a new company enter the industry. You can think of a company like a telecommunications company where you do require a lot of capital. So this obviously would have large entries or large barriers to entry. So the threat of a new entrant coming into the telecommunications sector would be quite low. Competitive rivalry, this one just means what is the degree of competition with competitors. So if you are directly competing with other companies, then this would be high. It typically is, somewhere in medium to high, since most companies are competing with similar companies producing similar products. Number 3, we have threat of substitutes. So this, you can ask yourself, is there a threat that there will be a better alternative? Again, you can think of the oil example. There would be a higher threat of substitutes there, since people are going to be moving towards renewable energy. So those oil companies will have a bit higher of the threat of substitutes at some point. You can even think of things like airplanes. There was studies done that showed that people wanted to look for a new renewable source of energy, or a different way to travel that didn't cause so many CO2 emissions. So there would be that consumer taste that wants it, but the threat of substitute isn't there yet. So it is low because there isn't a better alternative, but if there eventually is, then that would be quite high. Number 4, we have bargaining power of buyers. This is basically how much bargaining power do the people actually buying your products have. So you can think of this possibly like a telecommunications company. If you're buying their services, is the buyer bargaining for a better price, yes or no? So if yes, there'll be a higher bargaining power for the buyer. If no, then it will be low, which is better for the company. 5 is basically the same, except it's for suppliers. So do suppliers have high bargaining power or not? And so next we are going to be looking at the classifications for the industries by economic cycle. So first off, we do have cyclical industries. These are industries that typically do well in recoveries. So if you think to the pandemic that just happened, we had quite a big crash, and cyclical industries, they took a big hit, but on the recovery, they started to do really well. The main groups are commodities, so lumber, metals, chemicals. You can see that lumber really shot up as we were recovering through the pandemic, hit an all-time high. Industrials are another group, so transportation, capital goods, consumer discretionaries as well. Like I mentioned in a previous slide, consumer discretionaries are sort of items that consumers don't need to buy, they want to buy. So if obviously there's a market crash, that will basically cause people to have less discretionary income, so they won't be able to buy those things. So it does hurt those industries, and when consumers have more money to spend, these industries do well. So these are sensitive to the global and economic conditions, like I said. So something like the COVID-19 pandemic, that really hurt the cyclical industries, and then as the government is giving out a bunch of money, as the economy is looking better, these industries do much better as well. Swings in the prices of international commodity markets also do affect this, since commodities is one of the main groups. And changes in the Canadian dollar is also a big impact. And changes in the Canadian dollar also has a major impact on cyclical industries. A lot of these items, they are used to export. So when the Canadian dollar decreases, for example, more companies, or more countries, I should say, will want to buy these items from Canada. So that will increase the demand for these cyclical industries. And so the next industry by economic cycle is defensive industries. So these provide investors with stable returns, and they also do tend to do relatively well during recessions. So the main groups here are bank stocks and utility companies, so things like gas, water, electricity, and they are sensitive to interest rates and changes in long-term bond yields. So if you think to the pandemic, defensive industries, they should have done relatively well. Bank stocks, they did decrease by quite a bit. They were cut in half at least. So that is one area which didn't actually do too well in the recession, but typically they do all right. They did recover very quickly, so there was that. Utility companies, on the other hand, especially the sort of electricity companies, they didn't really decrease during the recession. People always need electricity, so these companies tend to always do well. They also tend to have a stable return because all of these companies, they usually provide a pretty nice dividend of 3 to 4% usually. So that is where you do get that stable return. You don't see too much capital appreciation within these stocks or these industries. So basically, this is just a great industry to have, or some great stocks to have if you think the economy is going to be going through a correction or a recession, since these won't be affected as much. And next we have speculative industries. So this basically just applies to industries in which risk and uncertainty are unusually high because analysts lack definitive information. So the main groups here are emerging industries, and it's because people are investing in that profit potential. A lot of these emerging industries, they don't have the valuation to back it up. You won't see that the companies are making profit, so you aren't really buying into that. You're buying more into that profit potential. So now that we went through a lot of fundamental analysis, ways of evaluating companies, we're going to look at technical analysis for a bit. Technical analysis, it is based on three main assumptions. So the first assumption is that all influences on market action are automatically accounted for or discounted in price activity. The second is prices move in trends, and those trends tend to persist for relatively long periods of time. And three is the future repeats the past. So you can see that these assumptions, they aren't always true. So that is why technical analysis isn't sort of a reliable thing in the investing industry. It definitely does help a little bit. It gives you a little bit of an idea as how prices may move, but it isn't always a guaranteed thing. So first we are going to be looking at the support and resistance levels. This is something that you do need to understand in stocks because it actually does have an impact, and you will see it sometimes and even hear about it if you're watching things like BNN. So basically the support level is basically that level where stocks won't decrease anymore. It sort of has stuff backing it up, and it will push the price back up. So you can see that if the price increases to a resistance level, which is where it won't go any higher because there is some resistance there, it will sort of fluctuate back down. So you can see that the low price is the support level and the resistance price is the top level. You can see that if a price does break through the resistance level, it may create a new one. So for example, that could be the cause of just some really positive information in the company. It might break through the resistance level and create a new one, and then obviously it would create a new support level as well. The same can be said if there was some negative information or something negative happened to the company. It could go down below the support level, and there it might create a new one, and there would be a new resistance level. So looking at the graph here, you can see that sort of it's the left shoulder here. So the price might increase and it will reach sort of a resistance level at the left shoulder, and it will drop down to what can be seen as sort of like a support level. Now once it does decrease here, it will have some increased volume and it will increase the stock price because of that, and it might break through that resistance level, reach the head here, and then it will decrease back down, reach another support level. So basically this is called a reversal pattern because the stock price is trying to increase, but it just cannot maintain it. So near the end, this is when the stock price might just decrease below. It tried going above its current price, but it just couldn't maintain that valuation. You can also have a head and shoulders pattern that is the inverse of this. So basically that is when the reversal will try to go down, but in the end it will end up going up. We also have a continuation pattern, and this is basically just a pause in an existing trend. So basically it's just a bunch of fluctuations that will happen, and it actually maintains the same sort of price. You can see that you can sort of draw a triangle, and you can see that it just fluctuates, but the price just maintains. So this is called a continuation pattern because it continues the same price. And so lastly, I do want to talk about quantitative analysis, and specifically the moving average. This is a pretty big part of the chapter. It talked about buy and sell signals. And it used the moving average sort of as a measure to determine these buy and sell signals. So first off, the moving average is calculated as the sum of the closing price for each period divided by the number of periods. Now, I do want to talk about the buy and sell signals. So as you can see in the graph here, the buy signal actually occurs when there is an increasing price and also high volume of trades. And it is when it actually goes upwards through the moving average. That's a signal to buy, since the moving average is going to then be increasing. And the opposite can be said for a sell signal. So it's when the price is falling on increased volume and it goes through the moving average from above. Now, I do want to mention that I may not have covered every single topic in this chapter, but these are just the main concepts that you guys should know. If you guys did enjoy the video and found it helpful, make sure to hit the thumbs up button and subscribe. I am going to be going over all of the chapters in the Canadian Securities course of Volume 2, so stay tuned for that.